Hello, everyone, and welcome once again to the final day of the India FinTech Week. Uh, it's been an amazing last 4 days where we have been having multiple conversations with a lot of interesting global speakers, a couple of entrepreneurs, technology leaders, and with that we also have like the today's agenda as well, pretty much exciting. So to begin with today's agenda, I have Mr. Paolo Sironi. Paolo is a global research leader, banking and financial markets at IBM Germany. And he's one of the most respected fintech voices worldwide, providing business expertise, strategic thinking to a network of executives among financial institutions, regulators, startups. He's also a former quantitative risk manager and himself is also a startup entrepreneur. So, and again, like Paulo's literature explores biological underpinnings of financial markets, how technologies and business innovations can bolster the whole global economy's immune system in today's volatile times. So, without further ado, I would like to hand over the mic to Paulo and take ahead with his keynote conversations with on platform economics in fintech. Paulo, over to you.
Thank you very much. So I'm very glad I have the chance to share with you, with the Indian community, is truly flattering. Now, the presentation today is centered on the content of my latest bestseller, Banks and Fintech on Platform Economies, which you see on the screen is my fifth book in the last year dedicated to the world of innovation in financial markets, banking, and economics. I am the global research leader in banking and financial markets for IBM Consulting, the Institute for Business Value, which is our global think tank for the discussion about the transformation of the industry. And I'm also a co-host of Breaking Banks Europe, which is the #1 fintech podcast worldwide, part of the Breaking Banks family. I invite you to attend. Now, I would like to start spending a few words, first of all, about my work, so that you may be able to frame the content.
Apologies, Paulo. Just to check, if you are sharing your screen, we can't see it right now.
Oh, yes, I was sharing my screen, but I guess I did not start it on this. Let me do this. Share the screen. Share it. Is now sharing?
Yes.
Okay, so here we are, Banks and Fintech on Platform Economies. So I said that I've been traveling pre-pandemic almost everywhere in the last 10 years, meeting clients, fintech entrepreneurs, regulators, people interested in fintech innovation. I think we can divide the world into three macro areas, although I don't want to forget anyone. It's a sheer simplification, but more or less, we can say that digital technology was born 15 years ago in the United States of America. The Chinese in particular are becoming very competitive in terms of technology, but largely speaking, technology was born in the US. Europe is where a lot of regulation is born because the European Commission has the interest in creating a capital markets union. And there's also a great emphasis on the protection of the final consumer. And the protection of consumers is absolutely important, also regulation for the stability of the financial system. But the fintech revolution is primarily a story that comes from Asia Pacific, in particular India and China, because there the business models are born. So my role is to understand the variety of business models, knowing that what works in India may not necessarily work in Guatemala or in Germany, understand how technology can scale these business models, reminding that the exponential technologies are not all at the same level of maturity. Like what we can do today with the AI, we could not do 5 years ago. What we will do 5 years from now with quantum computing, we cannot yet do today. But in the end, I want to keep everything in a regulatory framework in each jurisdiction, because it is important that we see innovation as part of a broader framework to improve the economic system and the financial system in which we work and operate. Now, clearly, if we talk about business models that scale with technology, we talk about the platform economy. If you look at this slide, you see the world economies and the tech companies on the same line, comparing the GDP, the gross domestic product of the major economies with the market capitalization of the major firms on Wall Street at the end of 2020. And you see that Apple, for example, was standing between France and Italy. So definitely the platforms are taking over not only the businesses, but in essence, the world itself. They're like countries by themselves. But when we talk about platform, in the context of the presentation today, we need to clearly understand the difference between platform and ecosystems, because what I want to talk about is the platform ecosystems. Now, if you look at this graph, I'm plotting here 4 quadrants. The horizontal axis says left, it is not a platform. Right, yes, it is a platform. The vertical axis says no, it is not an ecosystem. Yes, on top, it is an ecosystem. So if we start from the bottom left, we see that this quadrant is called single value chains. That means the output value, and there's a reason why I use the word output, is the linear orchestration of manufacturing and distribution of products. Now you can think here of any bank. Typically banks are linear marketplaces. That means there are manufacturers like the capital markets desks that invite corporate to issue bonds or stocks, as well as some of the private equity funds that basically provide private equity opportunities, private market opportunities. Then you might have somebody in the middle which assembles all of this, for example, asset managers or wealth managers that create the model portfolios or the individual investment funds. And then you have a distribution channel, which are people that talk to the final consumers, being the relationship managers in a branch or the private bankers for a wealth management institution. Now, if you now move from the bottom to the top left, the bundle value chains, we see that while single value chains were not ecosystems and were not platforms, the bundle value chains are not platforms, but they are ecosystems. For example, a private equity firm is a firm that orchestrates the interaction among people that live within a similar ecosystem, for example, the City of London, in order to provide the most relevant chief financial officer competence or marketing competence or technical competence to the company they acquire. So the output value is in the bespoke collaboration and aggregation among multiple value chains. Now, I'm not saying personalized by bespoke because people are not spontaneously gathering around a deal. So every time there has to be an effort to create something new for the specific private equity deal. So it leverages the ecosystem, but it is not a platform. If you move to the bottom right side of this quadrant, you have the digital value chains. Now, in a digital value chain, the output value is in the digital disintermediation of manufacturing and distribution of products. Now, digital is not necessarily an ecosystem, but it can be a platform. Now, what is the case here? You may have companies like Allfunds, for example, that allow wealth managers to find on their platform the most relevant investment fund that they want to propose to their customers. So the intermediary person that typically tries to connect the asset manager with a wealth management institution evaporates because people can self-direct themselves on the platform. However, it is not yet an ecosystem because there is always a linearity from the manufacturers through the assemblers to the distributors. Now, when you move to the upper right corner of this quadrant, you have the digital platform ecosystems and the value constellations. That's where we want to have a conversation today. And here you see that I'm already changing the language from output to outcome value, which is in the hyper-personalization of client engagement across multiple journeys. So now we want to discuss how banks and fintech can become platforms that allow the orchestration of ecosystems. So the discussion today is divided into 3 chapters about banking reinvention, which is the heart of this new book, Banks and Fintech on Platform Economies, which I invite you to see on the Amazon Marketplace. The first chapter is the Banking Reinvention Quadrant, which is at the heart of the new book. The second is how we map the fintech lesson learned of the last 10 years on the Banking Reinvention Quadrant to basically start avoiding the common mistakes and learning how to move up on the quadrant towards higher business value. And the third chapter is about how banks and fintech can succeed effectively on platform economies. At the bottom of this graph, at the bottom of every slide, you will see a bar that contains the content of the presentation today. It is highlighted in white where we are, so you know at any point in time where we are in the presentation. So we start with the first chapter, which is about the banking innovation quadrant. Now, there is a problem. I don't know if you see it the way I see it, but there's a lot of confusion in the fintech ecosystem and in the banking industry. For those my age, I'm 51. This is Laurel and Hardy, a comics, basically a movie that was shown at the beginning of the last century, the previous century, the 1900. Now, Laurel is sick, basically is on the bed, is the bank. He cannot move much. The central bank comes and tries to help him to recover, think about what happened in the global financial crisis. But at the same time, the central bank puts a cast on the bank. The bank cannot do everything that they used to do in the past. The fintech come, they want the bank, to be more agile, to move faster. They shake the bank, but the bank cannot really do as much as the fintech expect. Also, the legacy system are dragging the bank down to the floor, and the regulator, the system on top, comes from time to time to check that the bank has done its duty, right, taking the pills and the medication that the central bank were basically prescribing. Now, all of the actors need to learn something important in order to make a step on the side or forward or at the back in order to allow the whole situation to be resolved. So everyone has to do is own homework in order to facilitate the transformation of the industry and the creation of new value for clients. So to understand how these 5 actors needs to move, we need to go to the heart of the problem. So we're talking about a sick patient. So we need to understand where the sickness comes from, which is not about technology not being utilized. It's somewhere else. It is within the industry. So I don't know what you had in India for breakfast this morning, and I'm sure about your habits, but here in Germany, I had an orange juice. And since the 2008, after the default of Lehman Brothers, I've been having an orange juice made of freshly squeezed margins. So interest rates were brought to low levels, the cost of capital were raised by regulators, the regulation became required more transparency and intermediation with clients. So it was very difficult for banks. It's becoming very difficult for banks to make money out of interest rate margins, the most important function of a bank, which typically is the credit function. So banks started moving towards a few businesses across the globe, depends on the jurisdiction, but there as well, there is competition from other providers. For example, in investment management in the US, Vanguard has been bringing down the embedded commission of investment management products, as well as in the payment world. You see what happens. Maybe in the US, Square can still price up 100 basis points for a transaction, but in China and financial already prices 2, 3, 4 basis points. So the shift is towards a very low margin type of business in the payment world as well. So now this is what we are seeing in the world. We're seeing a trend that was not actually starting in 2008. We can go back into the 1300. There is the secular trend of the reduction of the interest rates. But in particular, you see here the Swiss and the European interest rates, so the green and the red dot, they became negative after 2016. You see the American in the US interest rates that went down and then started bouncing up again after the banks took the hit on the chin. But through the pandemic, the interest rate went down again. You see Australia. And on the quadrant here on top, you see the 3 months MIBOR of India. Even though there the interest rate is was 100 basis points in 2008, 1,300 basis points in 2010, went down in the global financial crisis, up again, you see what it is happening. So the trend, even for countries with higher interest rates, is for the lowering of interest rates, which is basically affecting the profitability without increase of volume of the interest rate margin operations of a bank. And what you see on the bottom left graph is the price to book ratio of the global banks from 2000 to 2020. So the price to book ratio can be read this way. If the PB ratio is above 1, banks are creating value for shareholders. If it is below 1, banks destroy value for shareholders. So you see that the blue area, the light blue area, is the 90% quintile of the banks. So most of them are destroying value for shareholders now. The blue line is the average of the global banks, and the black one is the European banks. So the European banks are effectively the most troubled on average banks as a system worldwide because of the intrinsic weaknesses of the European monetary system at present and the incomplete capital market union, which is affected by negative interest rates. So learning what happens in Europe is very important because, as we know, that interest rates are going down across the globe anyway, that might indicate what is going to happen anytime soon in any other jurisdiction. That is the reason why I would like to share with you the point of view of Mario Draghi. Mario Draghi is the former chairman of the European Central Bank. He left the office 2 years ago, and 2 weeks before leaving office, a journalist asked him if negative rates would create the next collapse of the financial system. Now, I want you to hear from his words what he said, which goes straight to the point of the presentation today in the new book, Banks and Fintech on Platform Economies.
Banks would like to have positive rates, unquestionably. So whenever they have negative rates, they don't like it. But I wouldn't go as far as saying the negative rates would cause the collapse of the financial system, because before getting there, one has to look at other things of our banks. For example, the cost-income ratio. Many of our banks have cost-income ratios which are completely way off any average indicator, both in Europe and even more so in the world, if compared with other banks in the other parts of the world. There are certain structural weaknesses in the banking sector, more pronounced in certain parts of the Eurozone than in others. I think these sort of considerations affect much more than negative rates, banks' profitability, banks' capacity to lend. The necessity to adjust the business model to the digitalization, to the changes in technology, is something much more compelling than being angry about negative rates.
Mind well, evil is in the details. Mario Draghi didn't say banks have to digitize their business model. He said banks have to adjust the business model to the digitalization of financial services. So the emphasis into the change of the business model, not in the digital technology itself. So without changing the business model, success will not be found. So the question, therefore, is what is this business model? Well, that's where I come to help with the Bank Innovation Quadrant, which is actually based, well, it's not really based on, but finds symmetry in this ECB working paper that the research unit of the European Central Bank published a few months after the speech of Mario Draghi. In this paper titled Intermediation with Technology, what's new and what's old, the researchers of the ECB say that financial intermediaries exert market power with superior information and communication. So we need to understand what is information and what is communication. Now, information is about core banking, everything that is stored inside the legacy systems of a bank that enables them to make their primary activities, in particular, deposits, lending, and payment, is the information of core banking. Communication instead is about the interfaces, which is how banks typically position opportunities in front of clients, like investment opportunities or insurance contracts. These are typically relationship-based, very human. Now, what happens is that with negative interest rate, it's very difficult to remunerate the shareholders after the price for risk with the core banking operations. Therefore, core banking needs to leverage banking as a service type of infrastructure that allows this information to be positioned outside the bank through an open banking, open finance framework in order to create new solutions, which is what I will call in a moment the contextual banking platform strategy. On the side of the interfaces instead, where the ECB researchers say that there will be more and more emphasis going forward in terms of generation of revenues in the banking industry, banks have to create a banking as a platform, which is just the other side of a banking as a service. That means integrating fintech offers on the banking solutions in a way to increase the value of the banking solution to basically enhance the value of the relationship, because then clients will have to pay for this relationship. And this is what I will call in a moment the conscious banking platform strategy. So what we can do, starting from the ECB research paper, is to take information and communication and use them as the two axes of the banking innovation quadrant. So the vertical axis will be the information quotient, and the horizontal axis will be the communication quotient. And this is the quadrant. The quadrant is made of low business value at the bottom left and high business value at the right-hand corner. If you intensify the information quotient moving up vertically, you go from products and services to platforms. That means closed ecosystems, then open ecosystems. And if you move to the right, you go from traditional distribution channels of products through data-driven distribution products into transparent intelligence. Now, let me start plotting most of the banking industry that we see today and the fintech scene on this quadrant. These are the two gray areas made of traditional banking and digital banking. Now, you might notice that digital banking doesn't cover the full space because there is a problem with the digital banks. Now, Accenture has estimated that between 2015 and 2018, $1 trillion were spent on digital transformations, but not much really happened. They say that there were more digital chrysalises than digital butterflies. Now, they don't tell you why, and I'm here to tell you why this is so and how to resolve this problem. So basically, what matters here is that in order to box out from this gray area, we need to understand two important lessons learned. The first one is that platform economies are about outcome economies, not anymore output economies. So we want to explain to you the difference between outputs and outcomes. The second lesson learned is that digital is a pull technology. So people go there only when they're self-directed, they know what they want. But most of the revenues that matter today in digital channels are push economy. So the question is how to put a push industry on a pull technology. So that's the way to do that. Now, once we learn how to move from output economies to outcome economies and from push to pull mechanisms, we basically move up in the banking engagement quadrant by intensifying the information quotient with trusted data on cloud, intensifying the communication quotient with trusted AI relationship. The combination builds intelligent automation that enables us to reach out to these two higher value spaces: contextual banking, where the bank is embedded into a third-party ecosystem, and conscious banking, where the bank is transparent in front of the clients who have to pay for accessing the financial services platform. So now I know that the banking innovation quadrant is a very busy quadrant and is an important quadrant for the navigation of the future of banks and fintech. Now, you can certainly read more by buying the banks and fintech on platform economies on your Amazon marketplace. I'm going to give you some highlights in the remaining part of this presentation so that you start understanding a bit more how to move up in the information quotient and how to shift right in the communication quotient. So we start with a lesson learned, which is about the output versus outcomes. Now, what is the main difference between an output economy and an output economy? Let's think about automotive. In the output economy, BMW decides as a target for a firm to sell 10 million new cars of the 7 Series in 2023. This is outputs, the quantities of cars. But should BMW want to operate on the outcome economy, BMW would, as they did, build an app, a service called Share Now, together with Mercedes-Benz, in order to allow 1 million citizens of Berlin to commute to the office every morning. The outcome is what matters, is the journey from A to B to go to the office. This outcome economy is asset light, and not because cars are not produced, they are produced, but because the client does not have to pay and invest into the asset. That means if you buy a BMW 7 Series, and then the first week of driving, you're like, I don't really like it that much. Most of us will not be able to give it back. You have to keep it for a while. But if you use a car sharing app and you don't like the experience on the app, you're not that sticky in the relationship. You can move to the next app. So the experience, therefore the engagement, becomes central into the outcome economy. The product here is the engagement or the relationship, and the way the client pays for that is different. And this is fundamental. What does it mean in terms of banking and financial markets? I'll give you an example. A bank that operates in the output economy wants to sell to clients in the next year $1 billion in asset under management of a monetary fund. Quantities. But the banks that wants to operate in the outcome economy wants to help their customers, families, entrepreneurs, businesses, to achieve their personal, their business, or their financial goals. It is the journey that the client goes through in their personal life that matters. That's the outcome. The underlying products are commoditized. They become, in a sense, less relevant. It's just the combination and the way the clients consume them that becomes super important. Now, this is a quintessential shift in the way banks conceive themselves, structure their business units, and define the monetization schemes. But it is essential because, you see, we already learned in the last 15 years of internet revolution that platforms were the winning players. Now, LinkedIn is the platform for my business life. I invite you all to connect with me on LinkedIn when I keep on sharing these conversations publicly. Facebook is the platform for my personal life. You can also find me on Facebook if you like. Amazon is the platform where I sell banks and fintech platform economies. Go there, take a copy. Twitter used to be the platform for my Trump paranoia. I still use Twitter, so you can also reach out to me there. And WeChat in China is the platform of all platforms. But the question becomes, where is the platform for my financial life, being contextualized or conscious solutions? Well, that is what it is addressed by banks and fintech on platform economies and sits in the future of the industry. But before we get in there, we need to understand also the other dimension of the bank innovation quadrant, which is the difference between push and pull motivation gaps. Now, I guess that South Park is a famous cartoon in India too. It is actually a kind of provocative cartoon, and this clip was live on American television in 2009 after the default of Lehman Brothers, so the start of the global financial crisis. So the little kid has some money to invest. He goes to the bank, and I want you to listen carefully to what happens in his conversation with the banker.
I got $100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
What's all gone?
The money in your account. It didn't do too well. It's gone.
What do you mean? I have $100.
Not anymore, you don't. Poof.
Well, what can I do to get back
I'm sorry, sir, but this line is for bank members only.
I just opened an account.
Do you have any money invested with this bank?
No, you just lost it all.
Then please stand aside for people who actually have money with us. Next, please.
So don't worry, these things don't happen in Mumbai, only in New York. However, the key element here is not about the banker per se. Let's assume that the conversation is always ethical in front of the client. But it's about the fact that the majority of customers have a harder time in understanding finance. That's why most of the banking products are sold more than they are bought. And this is at the heart of the asymmetry of information that shapes most of the banking revenues that matter, especially in a world of negative interest rates. Now, on this quadrant, I'm plotting the major business units of a financial institution. Let's say that on the horizontal graph, I have the intensity of information asymmetries from minimum to maximum. And on the vertical graph, I have the consumption model from demand-driven to offer-driven. So I'm positioning payment and borrowing to the bottom left and investing and insurance to the top right. Now, the bottom left I could pull. So clients typically understand the value proposition, even though sometimes it's not very transparent, like in payment, still they know the value for buying something because they get a good. But on the top right corner, I've got the push mechanism. So the offer-driven, most offer-driven part of the industry, investment management, insurance. Get it this way. If you go to your Amazon marketplace and want to buy something, you can do one click and buy one of my books. It's easy, right? So you like the mechanism, so you're happy to be on that platform because the friction is removed. It's okay. No surprise that the biggest fintech unicorns today are seen primarily in the payment world because that's very symmetrical. You can build volumes very fast. Still, you have to care about your profitability, but that goes fairly well. It can scale up. The next to come is borrowing, because it is a bit complex sometimes to borrow money, to know exactly what to do with the money, but typically the value proposition is understood. I'll give you an example. If you go to my web page, thepsironi.com, and you click on the first image you see, I will give you $1,000, 0 interest rates, 0 commissions. You give back the money to me whenever you want. I'm sure that every one of you will do that. And I'm happy to do this, but you know what? I don't have good analytics. I might end up into a big risk management problem here because most of you or some of you, might not be capable of paying me back anyway. So now borrowing is okay, but you see that when you use borrowing for onboarding clients, you need to care about the risk management piece. So it is always a constrained environment, and banks cannot do everything they want as long as they don't have big shoulders in order to accommodate for the risk management. And that's where most of the peer-to-peer platforms failed, apart from those that were scamming, as they did not understand that the consequences between connecting the two sides of the equation on the risk management side. But if I tell you, go to my thepsironi.com again and click on my second image, and you will give me $1,000 that I will invest into a model portfolio made of American stocks, 50%, 20% cryptocurrencies, and 30% Chinese stocks, but not from companies that operate in Guangdong because they pollute, and you are ESG-minded investors. I'm sure that it will all go to my LinkedIn profile, try to figure out who I know, if it is true that I was a risk manager in quantitative finance for 15 years, if I know about investing, if I have an experience, if I know about portfolio theory, and so on and so forth. So you see, there is a distance between us. The asymmetry starts building. You may not trust me that much. So no surprise that through the pandemic, the robo-advisors did not grow as expected, or at least not as much as the retail trading, because some of the retail trading platforms were leveraging the FOMO, the fear of missing out, that should not be leveraged, to lure in investors. So without a very asymmetrical proposition that should not be allowed by regulators, investment management has a hard time in scaling without human relationships. But we go to insurance, which is the most asymmetrical of all the financial businesses on average. And I give you this example. Suppose that I want to sell to you life insurance. I have to tell you that you're going to die. And you don't want to have this conversation with a chatbot, do you? So that you see, understanding the intensity of the simple information explains the gap between the demand-driven part of the business and the offer-driven part of the business. Remember, mobile is a pull technology. You expect that people know how to direct themselves, but most of the revenues that matter, especially in a low interest rate environment, high cost of capital towards investment and insurance management, operate in an offer-driven economy. So you need to learn how to position an offer-driven business onto demand-driven technology. And this is where I believe we need a new perspective. It is true that data-driven banking is important. It is, but there is something more important than that should precede it, which is the data-enabled client. So we're seeing this whole picture upside down. And I will get back to this concept at the very end with an example of Amazon about the history of Jeff Bezos, which is truly revealing. So now, by understanding, as I said, how to differentiate between output economies and outcome economies, understand how to differentiate between pull mechanism and push mechanisms, banks and fintech can break out the confined space of the digital bank and lead into contextual banking platform strategies where the bank is invisible, embedded, and conscious banking platform strategies where the bank remains visible and transparent. So now, there could be some examples that we want to present about contextual banking and conscious banking. I will go through this example a bit fast, but we can have a conversation later on. Some come from India as well as some of my IBM clients. Now, this is a work I did for Shanghai Pudong Development Bank in 2020. SPDB is the 8th largest bank in China. So it's not one of the largest banks, it's as big as Deutsche Bank in terms of assets, but it is the most digital bank among the urban banks. And the board of the bank asked me, how can we basically compete with WeChat and Ant Financial? So we created a paper, which is a strategic paper at the heart. You find it at the Bank Innovation Quadrant. And this paper has been published in Chinese. It's titled The Panoramic Banking. That means translation from Chinese to English, like holistic banking. And we co-presented, I co-presented with the president of the bank at the Unfinancial Conference Fintech Inclusion that was held in Shanghai last year in September. Now, the point here is that you have a lot of retail clients now. India is already like China. It's not like China in terms of the big tech platforms. It's a bit behind, though it's catching up a lot, and definitely there's more opportunities for financial inclusion. So to grow by connecting the retail clients at scale compared to other parts of the Western world. But let's say that you've got all of these retail clients, and in many jurisdictions they are basically already connected to big tech platforms, and then you have the businesses that basically address their solutions to these individual clients. Now, what I'm seeing is that there is a lot of banks that are trying to basically capture these clients in the interaction between businesses and these clients. For example, SBI, State Bank of India, you know them well, is the largest bank, 350 million clients connected, much more when I tell to my US friends than the US population itself. But SBI launched, you only need one that you're aware of, which is a marketplace. So they're trying to enter the platform economy through a more traditional marketplace. That means selling products like Amazon. But then they put digital wallet in the middle. And through that one, they can start basically positioning investment products, insurance products, as well as inviting businesses to participate to the marketplace to complete basically the platform journey. Very interesting proposition. The second one is DBS in Singapore. You may know them well. So DBS created different marketplaces for car buying or travel purchases, real estate, and education. But let's say that DBS worked originally on vertical separated marketplaces, and we are learning in a moment that the value really is in the interconnectivity among these. On platform economies, you make no discount on the fact that you need to be horizontal and holistic. Another interesting example, a smaller example that is an IBM client is Bank of Baroda. Bank of Baroda, as you know, in India, orchestrated a platform, Baroda Kisan, to basically help the farmers resolve their farming needs and then leverage from there in terms of providing banking services through digital wallet, could be the leasing for the machinery, so on and so forth. Another interesting example is Ping An Bank or Ping An in the insurance side of their business because they created one of the most successful digital platforms for insurance, starting from Good Doctors, where people can find the doctor. And then the relationship is moved towards a brokerage business that enables the insurance company to basically perform and fulfill. But there is an element here that matters to me. What matters is that in order to monetize on platform economies, you really need to be truly holistic and truly panoramic. So what matters is that when you conceive your architecture, you build omni-intelligent connections at the heart of your architecture. Remember what we said before, the two quadrants, information quotient and communication quotient, that enables you to interact with an omni-business marketplace that in itself will connect you with an omni-user perspective. You could take different directions to do that, but I guess that this way of working would be most suited in most parts of the world, especially given the competition, which is already rampant from the big tech companies that typically are dominating the retail world. And what happens instead on the other side of the banking invention quadrant, so the conscious banking platform strategy? So I had conversations with the CEOs of financial institutions through my career, and I went here to plot a few that I find relevant. The first one, I was talking at Paris Fintech Forum in 2017, and Frédéric Oudéa, the chairman of CEO of Société Générale, the French bank, was speaking before me, and he said, you know, what is really happening in financial services is a shift from transactions to services. What does it mean to me in my simple language? It means changing from a linear distribution channel of products into the multi-sided packaging of advice that generate value for final consumers. Now, the year after, still at Paris Fintech Forum, I was sitting with Yves Perrier. Yves Perrier is the chief executive officer of Amundi, one of the largest asset managers in the world, possibly the seventh, if I'm not mistaken. And I asked him the question, what justify the fees? Now, in a linear value chain of traditional banking or digital banking, Yves is a manufacturer. He's at the very beginning. And I want you to listen from his words, what he said, to answer my question.
And I think that the real value which is brought either by banks or asset managers or life insurance companies. It's firstly a service of advice and permanent advice during the time of their investment.
Yes, the value question is basically he said the relationship, the advisory mechanism at the other end of the gamma, everything else commoditizes. So you need to transform the relationship. That's why, don't forget, engagement is the product in contextual banking. Relationship is the product in conscious banking. And then last but not least, I was sitting on the main stage with Larry Fink, the CEO of BlackRock, the largest asset manager in the world, and in Chicago at the Morningstar event. And he said that 4 years ago, that he wants 30% of BlackRock revenues to come not from products, but from services. That mean pushing technology to the forefront where there is a relationship. And no surprise that I was invited to open most of the investors conferences of BlackRock in 2019, and I'm still glad that BlackRock distributed my literature to their precious audience. So now, to conclude the presentation today, I want to share this story, which is a personal story and which is one of the secret sources of Amazon success, even though you really have to take the e-commerce story in quotes, because I told you e-commerce may be more symmetrical than what banks have to do, but there is an important lesson learned to be learned here. When I was much, much younger, in the 1990s, I was helping my brother to build the Amazon of Italy. We wanted to sell the best of Italy: fashion, food, furniture, and travel. We had a very good slick design for our website, and we did not sell anything. It didn't go well. And many years after, I was reflecting on the experience of my first startup, and I listened to an interview of Jeff Bezos on 60 Minutes, an American TV show. And the journalist asked Jeff Bezos, what is Amazon? Now, if you are my age, you will remember that in the very early years, Amazon was primarily selling books and only books on the internet. So Jeff Bezos said, Amazon is not a distribution channel of books on the internet. So I was frowning, and the journalist was puzzled. So he said, you're not? So what are you? So he said, well, understand this. So the question is a bank a distribution channel of products on digital? He said, the publishers are sending me letters complaining that I don't understand the marketing. You call him stupid, right? Because they say that I allow users to post positive and negative reviews on Amazon, but I should only post the positive reviews because this way the publishers could sell more. And he goes, they don't understand. I am not a distribution channel of books on the internet. So then a bank is not a distribution channel of products on mobile technology. He said, my role as Amazon is to advise the client on which is the best book to buy, because as people cannot touch the book and smell the glue, they may be there, but they don't move, they don't make transactions. So only after, he says, I can plug in analytics to work with the client. So advice first, data enable the client first, and then data driven only afterwards. That's what he said. And this is a good lesson that I want to share with you, not only because you will find 5-star reviews on Amazon about my book, but because if you still conceive digital banking as a linear marketplace, you will not succeed. If you think instead in terms of platform economies, you will allow your bank and fintech to box out and reach out to new value spaces dominated by the contextual banking and the conscious banking platform strategies. So don't forget, it is the opportunity to eliminate ecosystem frictions that makes banking contextualized, that means embedded, to unlock new value. It is the need to demonstrate value for clients that makes banking conscious, transparent, to unlock hidden value. I thank you for the time you dedicated to the presentation today. This is the QR code of my LinkedIn profile. You can scan it so you can connect with me on LinkedIn. Please do so. We can have continuous conversations. And don't forget, banks and fintech on platform economies, contextual and conscious banking has been a hot new release on Amazon in banking books for the last 2-3 months. It is available on your Amazon marketplace. I would be pleased if you would want to read it and then share your comments on social media. Thanks for your time.
Great. Thank you so much, Paolo. It was really an amazing presentation, and I think like that gave us a quite a different perspective in terms of how we should look in terms of the overall banking and digital banking as a distribution channel for like financial products. With that, though we are running a little late on the time, but maybe we can take one specific question. So Kirti has a specific question, that does platformization means that banks will have to be more customer centric than ever?
Yes, but we need to make again a semantic difference here, because many conceive customer centric like the client is at the center of a target of a marketing mechanism. That's not good hyper personalization, because you still think as a distribution channel of products. Customer centric means being client centric. What matters from the client is to go from A to B. What is the problem? The problem is the following. I'll give you an example. If you think about automotive, again, in a more linear marketplace example, but when the car maker builds the car, they talk with the manufacturers, they assemble it, and then you as a client, you go in front of the car dealer, and you can hyper-personalize that's a car you want to buy according to your wealth. And then you go out with the Navi system you want, the Tiptronic you prefer, or the leather seat, the leatherback seat that is made by a leather of an Italian artisan. And you go from A to B, which is all impressing. You're not going back to pay for all of these customization one by one. But think about how the bank operates. Now, in order to fulfill your financial journey in life, you need the saving account, but it's not enough. You also need a loan or a mortgage, and you might need to invest some money, and you need a retirement product, and you need a payment mechanism. Like, you cannot only have one. It would be like buying a car that only has a steering wheel that doesn't work. However, the bank sells to you this product in a very disjointed way. You buy today a saving product, then you buy a payment product, then you might buy an investment product. There's no cohesion among these, and there's different KYC. So in reality, what matters is that through time, and I know it's more difficult because it's happened through times, you have all what matters to you in order to resolve your financial problem. And that is the journey, that is the engagement, that is the relationship. The products are less important because you need to create an all-in pricing. And this is basically happening now. I just give you an example, which is more on conscious banking and contextual banking. If I ask you which is the biggest Swiss bank, what would you say? You may say UBS. If you ask you which is the second, what would you say? You may say Credit Suisse. Right. And then you're all wrong. Because FTSE Russell, the provider of the stocks indices on the market cap, on the capital markets, took UBS and Credit Suisse out of the banking index 2 years ago. Because they said that most of the revenues don't come from core banking, but interfaces. Remember the bank intervention quadrant. So UBS is now flagged as an asset manager in the index, and Credit Suisse as a diversified financial conglomerate. So the shift of revenues is happening, especially in those countries where banks were hit on the chin more by the macroeconomic conditions, which are propagating around the world. So you just see like a movie in anticipation to what might happen in India as well. But in that shift, some of these banks are now trying to sell the portfolio management for zero commissions, and then they try to invite the clients to pay for the relationship on top. I know it's complex. You need technology, you need artificial intelligence, but then don't have client centricity as the target of a marketing mechanism. Have it as the centricity of the human needs that you might want to address with your fintech or banking solution. And then clients will pay for access to the financial services platform in a more stable and sustainable way.
Right. No, thanks a lot, Paolo. And I think that's quite an interesting point that you mentioned, that when it comes to customer centricity, the most important aspect comes is like, how can we aggregate data of a single customer who is purchasing multiple products from a like single bank itself. And I think right now India itself is taking a leap ahead with the like formats of account aggregation frameworks, which has been come up recently.
Oh, the India stack is amazing. Like, it's very competitive. I tell you, in my second book, Fintech Innovation, the first one to tweet about my second book is the founder of a robo-advisor. And he said, Paolo Sironi Strange says that regulation is the heart of innovation. And I said, yes, I tell you, right? Because especially in financial services, if you don't have an ecosystem and industry perspective, you cannot make it happen. So the open banking was very limited. The Indian stack comes from a regulatory perspective, right? So it provides the battlefield that enables everyone to move forward with more comfort. Think about the identity problem, right? So I do believe that India has what it takes to accelerate even further. And it's a wonderful place for entrepreneurs today to work and to live in. Kudos, my friends.
Absolutely. I with as much as I would love to chat with you and like ask you a couple of questions around like digital banking for the next decade ahead, but still we are already running behind on schedule. So I would have to take a pause here and move ahead with our next panel discussion, which is there around how data can drive the next generation for digital finance. And with that, I would like to thank you, Paolo, for joining us today and supporting us for the India FinTech Week here.
You're welcome. Ciao.